Is expanding your business worth risking assets, or do you want to keep them out of reach of a lender? Often that's what it comes down to when selecting the right business loan for your circumstances. In this video, we'll help you find out if a secured or unsecured loan is right for you. Growing a business often requires a solid financial foundation, with many businesses relying on credit to fund operations, expansion, or unforeseen costs. But what's the best type of loan for your business? For many, it boils down to a choice between two options: a secured loan or an unsecured business loan. Selecting the right option isn't always straightforward, as each type of loan brings its own set of benefits, potential drawbacks, and suitability for different types of businesses. In this video, we'll break down the features of these loans, compare them, and examine practical scenarios to help determine which loan type could be the best fit for your business. Secured loans are a type of financing backed by security, an asset the lender can claim if the loan defaults. This asset could be real estate, inventory, equipment, or even accounts receivable. Secured loans often come with benefits like lower interest rates and higher borrowing limits, as lenders have some guarantee against loss. For instance, a manufacturing business looking to purchase high-cost equipment may choose a secured loan, using the equipment itself as security. This type of loan structure is commonly used for equipment financing, commercial real estate, term loans, and some lines of credit. In contrast, unsecured loans do not require security in the form of property. Approval for these loans hinges on a borrower's credit score, cash flow, and financial history. While there are bad credit unsecured lenders, a strong credit profile makes a better outcome for borrowers with more lender options. Without property or asset securing a loan, the risks a lender takes on are higher, and this is typically represented by higher interest rates and generally lower borrowing limits than secured loans. Unsecured loans are ideal for business owners that either don't have substantial assets to pledge as security or need faster access to funds due to an assessment process that doesn't involve evaluation. These loans are often used for working capital, marketing campaigns, technology upgrades, and other short-term or immediate funding needs. They can come in the form of term loans and lines of credit. The primary distinction between these loan types lies in security. Secured loans require an asset to back the loan, while unsecured loans do not. This difference affects not only eligibility and loan conditions, but also the borrower's risk and cost obligations. Secured loans typically offer lower costs due to their reduced risk for lenders, but they require businesses to put their assets on the table. Unsecured loans, by contrast, offer greater accessibility for asset-light businesses, but tend to be more expensive. Since the lender has security, they assume less risk, which translates into lower interest rates for the borrower. For example, secured loans for equipment financing may offer interest rates several percentage points lower than unsecured options, saving businesses significant costs over time. The value of the security often determines the loan limit, enabling businesses to secure larger amounts for long-term growth projects like property acquisition or large-scale renovations. Secured loans frequently come with longer repayment terms, providing businesses with more manageable monthly payments and reducing immediate financial strain. The main disadvantage of secured loans is the risk of reduced flexibility of the assets during the term of the loan. Potentially, they're also at risk if the loan defaults. Secured loans require evaluations of the security, which can involve asset appraisals and legal checks. This makes the approval process slower, often unsuitable for businesses needing fast financing. Without security, the approval process for unsecured loans is quicker and simpler, often completed within hours or a few days. This can be ideal for businesses that require immediate funds for operational expenses or unexpected costs. Some lenders offer flexible repayment structures, which can be customized to match a business's cash flow and financial circumstances. Without security, lenders take on more risk, which translates into higher interest rates. This can result in greater overall borrowing costs, making unsecured loans more expensive for long-term financing. Due to the lack of security, unsecured loans usually have lower borrowing limits, making them less suitable for large projects or capital-intensive purchases. For secured loans, the lender will complete a valuation of the security, which could involve an appraisal of assets or a property valuation. This can add both time and cost to the approval process. Secured loans can sometimes require more documentation than an unsecured loan, including proof of asset ownership, financial statements, and tax portal information. Due to valuation requirements, secured loans typically will take longer than unsecured loans to be approved and settled. Without security, the lender's focus shifts to the borrower's credit score, cash flow, and liquidity. The approval decision hinges on these indicators, making credit score and consistent cash flow crucial to demonstrate serviceability. Unsecured loans usually require fewer documents, often limited to a read-only assessment of business bank account statements. The absence of security means that non-bank unsecured loans are typically approved within a few hours to a day, allowing businesses quick access to funds. For companies looking to expand operations or purchase commercial property, a secured loan can provide the necessary capital at a manageable cost. Businesses requiring expensive machinery or vehicles may benefit from secured loans, as they can use the purchased asset itself as security. Unsecured loans, often ideal for businesses needing quick cash to cover day-to-day expenses or smooth out cash flow fluctuations. Companies planning short-term promotional activities or digital marketing efforts can benefit from unsecured loans, using funds without asset risk. For technology-driven businesses or those facing urgent repairs, unsecured loans offer fast funding with minimal paperwork. Secured loans provide access to larger amounts at lower rates, ideal for asset-backed projects and longer-term financing. Unsecured loans, with their fast approval and lack of security requirements, offer flexibility for short-term needs and cash flow management. Which is right for you depends on your circumstances. That's all for today's video. I hope you got value from it. Catch you next time. Bye.